Namaskaram to everyone. Hi, hello. Today let's talk about this book, Options Trading for Dummies. I think I prepared one presentation. I think you will like it. See, this is a content is definitely very nice. Learning, if you one thing before I would like to say, do not come into the markets for just for making money. You should be a continuous learner, and you should have a coach and a mentor to do these things. I known people who have lost thousands of dollars into the markets. I'm giving a disclaimer: do not enter into the stock market or into the options trading just because there is an probability of making money, high chances of making money. Wherever you see a probability of high chances of money, there is also a probability of high chance of losing money. Risk reward, until unless you know what is your risk reward, what is your pain point, what is your emotional point, what is your enough is enough kind of thing. If you come, you are causing pain to yourself. I don't want to use the F words and B words. Don't. I'm just trying to be very nice and very straight with you, because people work for capital, and I don't want people to. There are days where I cried when I lost my capital. Um, I don't want that to happen. See, my voice is becoming slow, but anyway, let's talk. Options are basically nothing but a contract which gives you right to buy and right to sell also. You actually make money based on the premium invested and the profit, whatever flexibility. I think in the earlier slides I have shown, or I have shown you how calls and puts on work. Choose to exercise or let expire. You can buy a call, you can put a you can buy a call, or you can buy a put, and you can let it expire, or let it you can sell it if you before the expiry. That makes you really strong in sense. If you're making profit, that's good. In some European models, what they will do is they will ask you the underlying asset to supply at the end of the after the strike price if you are still holding. So it is good that you close it, make sure which market you are entering, and if they are asking you delivery after the strike price, make sure you have the delivery content. If you are not having delivery and if you are holding, then it will cause a problem to you. Okay, all right. Okay, strike price, expiration date, premium, that's what I was talking. So important thing, you have to understand that. Option pricing, underlying asset price, time to expiration, volatility, time, all those things are included. So make sure when you are entering into the contract, buying or sell side, buying put or selling call, buying call or selling call, buying put or selling put, or doing all this for in different strategies, straddles, iron condors, butterfly. Do look at all these things important. Just because you want to make money, do not do all these things. Intrinsic value, amount of option in the money, time value, extra premium. Intrinsic money, if you are in the money options, intrinsic value, it will have time value also, it will have, but it will be very less. It's like, I think it's, you can compare with a bag full of chips packet, where you have air and you don't have air. If it is air is a time and chips is your intrinsic value, something like that. I think I learned this from NK stock. Nitin sir, that's so that was very nice way of he explaining things. I really liked the way he said. Then the basic option strategy: long call, buy a call, profit from the price increase. If the price increases, you make money. Long put, you buying a put, profit from the price decrease. Covered call, you sell a call and own a stock. That's call, you already have a thousand is considering 1,000 is a lot. If you have 1,000 underlying equity, and you can sell one lot there. So if considering not too much upside and considering not too much downside, because if you really know something is going bad, then you will not own the stock. Simple. Protective put, the same thing. If you really like to, you do not know what's coming to the results, then it's good you have a protective put, or anything, anytime when you see unnecessary volatility, unknown is there, and you still want to own that asset, you don't want to miss the dividends and all those things, just buy the protective put. So let's go to the advanced option strategy. Simple: spreads, straddles, iron condors. In the courses, we will talk further how you can make money at any point of time, how you can deploy multiple strategies to get the best return on your capital. This is very important, and how you can combine multiple options with a limited risk. Buying and put at the same strike price during the election time, or during some event generated time, that will actually give you a good money over there. Greeks in options trading: delta, gamma, theta, vega. Delta is rate of change versus underlying. Sometimes your underlying might be changing very fast, but your option price may not change. The vice versa can also happen. Gamma's rate of change of delta, theta time decay. So these are very, very important things, because sometimes based on the time only you have to you can always, one thing I like in options is credit related contracts. You can do it, which really makes money, because majority of the time 20% extreme swings will happen on buy side, 20% extreme down swings will happen, remaining 60% stock always because range bound. So 60% you will always make money with the theta based models. Vega sensitive to volatility changes. Okay, position sizing here, risk management, position sizing, stop loss orders, diversification, spreads across multiple trades and assets, which really makes good money for you. Stop loss, make sure stop loss is very important in options, because if you are buying, if you are on debit spreads and if you are not having a stop losses, don't tell me you will be in losses. Volatility in options, historical volatility, implied volatility, you have to look at what are the historical, how it is different implied volatility across strike prices, different implied, just look at it. And options order types, market order, limit order, stop order, I think this is for the very basic people. I don't think this is very, limit means whatever price you till let's think you keep it 10 units or 10 price points, till the 10 didn't come, then the market never triggers your price. Market orders, whatever is the price they will take. Stop order, if it comes to this price, you take it. Options trading platform, desktop platforms, mobile apps, web based. Nowadays you have so many things, retail, institutions, market participants. I would say like you increase more than books. I seen like books and courses, paper trading, market analysis. I'll come to the books and courses. Books and courses will help you, but the point is in the books and courses is, I'll tell you like this: a real doctor cannot become a doctor unless he goes through that training period of hands-on. Just because everyone have the access to the theory, every book is like a theory. Course is next step to the theory. If you know there is something like teacher, mentor, and the guru who actually coach. So every role has its own. So get someone who can really help you, like mentor, coach. I can help you in that, but there isn't a program which is called 1:10, where you keep 1 but the return is 10. So those kind of trades I will let you know in my course, but that's $10,000 thing. Very important thing is, just by doing paper trading, simulation you can do, but you do not know what you will do. It's like real surgery and without surgery, or real driving and without driving. You can do 100 times, you can do video. It's like kids doing video gaming, but in reality they may not able to drive on the roads. The same thing, don't do mistakes with your lives. And market analysis, stay informed on the economic trends. I think that's all I have. One good thing I can talk about, 1:10 trades. 1:10 trades, there are students who really like it that way. The way I said, the 1:10, when should you take the position, how you should take, how you have to use the indicators to on your good, how you have to use the events, how you have to use the equinox situations. I think RSIs, Bollinger Bands, we speak about multiple indicators, and we speak about events driven, and you don't have to trade the entire year. You just have to trade 4 or 5 times in a year, and bang, 1:10 you keep it. If 1:1, if something goes wrong, you should be ready to lose that one side. That's 10%, 90%. If something goes wrong, good. Bad thing, 10%. If something goes good, 10%, 10 times you will make in matter of 1 month or 2 months. So these kind of trades, since these are risky trades, this is only for experienced people. I would say like this is purely educational purpose. If you really want, connect with me. I will open the pay gates for you, so you can pay me, and then we can take it further. Thank you. Bye all.